Hi, good afternoon, everyone, and welcome back to our video series where we discuss everyday legal topics with TLR Law. TLR Law has a mission to make law accessible for the average Canadian, including entrepreneurs who are looking to sell their business. Every entrepreneur, of course, dreams of the success of his or her business, and that includes, or often means, selling it when the time is right. So selling a business can be very complex, whether you're selling to a family member or to a rival. And today we're going to dive into some of the things, some of the issues that you'll need to deal with from a legal perspective. And we've got as our guide here today, Philippe Rouchet, principal lawyer and co-owner of TLR Law Office. My name is Adam Dooley, and we're ready to go. How are you doing today, Philippe?
I'm good, Adam. Thank you. How are you?
I'm doing great, except the weather seems to be turning, and we're expecting winter to arrive, I suppose, in the next couple of weeks.
It's inevitable, isn't it?
But
Unfortunately.
there are positives that we can go skiing and snowboarding potentially pretty soon. So those are always good things to do. So this is so as a business owner, this is something that I've thought about from time to time, selling my business, and I know that that other business owners that I've talked to, this is a topic that always gains a lot of interest. So why don't we start this little journey by looking at the difference of selling to a family member as opposed to a third party, like a rival or somebody else? What are the
Yeah.
differences?
Yeah. Before I jump into that, the entrepreneurs think about selling their businesses probably about 3 times a year. Normally, usually when you are super busy or you have a lot of problems, the one thing you want to do is to get out of it. But seriously, so I've often had people phone me, I want to sell my business now. But that's
Get
usually the
me out of
worst time to
here.
sell it. Yeah. That's usually the worst time to sell your business because typically, if you're trying to sell it then because you have problems, then whatever purchaser is going to come around is going to see the problems, and you're probably not going to get the dollars out of it. So selling a business really is a strategic decision you have to make, and it's a decision that you have to make long in advance prior to selling the business. And there's a saying that goes, when do you start thinking about selling your business? You usually should start thinking about when you start your business. There's a lot of things that you need to do. And one of the things you need to do is you need to think about who you're selling your business to. If you're looking for there's two ways, I guess, conceptually, if you want to think of it, of transitioning out of the business. One, you can think in terms of a legacy that you're leaving, and maybe it's your kids. You want to bring your kids into the business because they've demonstrated an interest. It could be other family members, nieces, nephews. There's a lot of these multi-generation businesses now that it goes down from parent or from one person down to maybe nephews and nieces, and then you bring in various people depending on their strengths. And the other way, of course, is cashing in. That's where you get your money out of the business, all that time that you've invested. And it's for a lot of entrepreneurs, it's your retirement fund, right? You put your energy, your soul, all of your money into your business. And the hope is one day you get to sell it to somebody and somebody else, another entity, and then you can cash in, and that's your retirement. So it really depends how you look at it. If you're looking at the first option I was talking about, that kind of legacy where you bring in either kids or family members or even maybe key employees, you're not cashing in right away usually in those cases, because usually those people you're trying to bring in don't have access to the cash needed to buy the business outright from you. So there's some work that you can do, some corporate work and some tax work that you need to do. You would just talk to your accountant, your lawyer about that. Essentially, you freeze the value of your corporation into some preference shares that you yourself hold, and you issue new shares to the new generation. The new generation, they run the business, they generate profit, and out of that profit, over a number of years afterwards, you cash in a certain amount of your preference shares. So think of it as chips. You get a bunch of chips at the table, and then you just, over a period of time, as long as there's cash in the business, you cash in your chips, and then you take an income that way. So you can be paid over 5 years, 10 years, 15 years, depends what the value is.
Right.
But that's a whole different corporate strategy that you need to talk about with your accountant and your lawyer. There's a bunch of stuff a bunch of work that has to go into getting that done. And that's not really, I think, the direction we're going to take today. Today we're going to talk about the exciting retirement fund, cashing in. For a lot of business owners, they've dreamed about this moment, especially those 3 times a year I was talking about earlier when you have problems. You go, finally, I can sit on a beach in Costa Rica and sip on margaritas all day long.
All right. Well, when you do that, I'm expecting an invitation. But you're right.
Yeah.
I think this is when we're contemplating selling a business that you've spent maybe 10 or 20 or 30 years building. It's likely the largest transaction of your life and probably the most important transaction of your life. And so when I'm thinking about it, it's like I can't imagine at a time when like this that I wouldn't want a lawyer, the best possible lawyer I could muster. So tell me a little bit about why a lawyer is so indispensable for the seller in this kind of situation.
Well, there's probably 2 areas that the lawyer is important in this case, and today we're talking about law because that's the area that I'm in. But really, it's all your professionals. You need to get your accountant involved as well in managing your business. So one of them is managing your business, right? You can't sell the business if somebody doesn't find your business attractive, and finding your business attractive means that your books are done properly, that your taxes are paid. It means you're on the legal side. Pardon me. It means you have contracts for your employees. We've talked about the liability of having employees without contracts. So having contracts in place for your employees, having a proper anti-spam policy, that you're not emailing everybody without having the ability to unsubscribe, because that's liability. It means complying with your privacy obligations. So all of these things are things that a business owner can do while they're running the business on a day-to-day basis. You don't have to put them all in place if you don't have anything at the same time, but it should be in your strategic plan, and you should be meeting regularly on an annual basis or quarterly. I know in our office we meet on the business side and meet quarterly, and we talk about these things and what's the next step that we want to put into place, and making sure that those key elements and those key parts of the business that affect your legal standing and that prevent you from receiving or protect you from huge fines are in place, so that you don't run into trouble with stuff that's outside of your area of expertise.
Right, and the buyer is going to look at you. I mean, it's going to be a more attractive purchase if the company is well managed, has all these processes in place, is protecting itself, and that way it's easier to purchase, easier to just pick up and start running under the new ownership. All of those things flow from what you just said.
Right, and it's worth money, right? When you think about it, a purchaser is going to pay a premium for a well-run company. So if you're able to show profit, first of all, because obviously somebody's going to want to buy you, who's going to want to make sure that there's profitability there, but so that you're able to show that your numbers look good, that you're consistently running a profit, that your sales are relatively stable or that are growing gradually over the number of years. And then you have all of those other key areas that where it's the risk mitigation that you're protecting yourself. A buyer is going to come along and say, look, there's not a lot of risk here because these people, this business owner has put everything into place to begin with, and has dealt with all these other issues, so I don't have to deal with it. So that's worth money to me as a buyer. And they're offering a nice income stream that I can kind of pick up. So it's easy for them to finance that because they can put in their own money, which is usually about 25%. And then they borrow the rest. The banks are going to be happy with that because it's showing the nice cash flow and all of the risk factors are taken care of. If you have real property, there's another one, like environmental issues. You have to make sure that those things are addressed. So there's a lot of things that you can do prior, like years in advance before you even get close to selling your business. And this is what I meant earlier by when's the best time to start thinking about selling your business. It's when you start your business. Put all of these things into place and make sure that you're running a proper business and you're running the kind of margins your industry should be mandating, as well as making sure that all the other stuff is in place. Then when you start getting purchasers, when you're ready, you can start accepting or entertaining offers. Again, key is to have your lawyer involved at that point, because your lawyer will allow you to take the least amount of risk possible when you give the business over for the most amount of cash.
Right. So let's talk about that a little bit, and then we can get into some of the other things about how to actually sell the company. So
Right.
how do you structure it so that you're protecting yourself and getting the most amount of cash that you possibly can? I think of deals that I've heard where a business owner is required to stick with the new company for the transition period, say a year or 2 years, and won't be paid the full amount of the deal price until at the end of that period.
Right.
That's just one scenario, but can you talk about a few others?
Yeah, well, there's a number of scenarios. So from a buyer's point of view, the kind of delayed payment or payment based on the amount of revenue that's been generated under the new buyer, those are always better from the buyer's perspective and always worse from the vendor's perspective. The vendor wants to sell the business and get the cash and get out of there.
Get the cash
Right?
money up front and go. Yeah, go to Costa
Right.
Rica. Yeah.
Exactly. It's hard to enjoy your margarita in Costa Rica, on the beach in Costa Rica, when all you have is an IOU in your pocket.
Right.
They don't really take that in Costa Rica. So the best solution from the vendor is to get all the cash on possession date or on the date where the transaction occurs, and then and to no longer have any responsibility. So the best analogy I can give you is buying a house.
Right.
Okay, so let's think about when you buy a house. When you buy a house, you buy as is, where is. Everybody knows what that means. It means that once you have the house, it's yours. Whatever problems exist in the house, they're your problems. The vendor is no longer responsible for any of those things. The vendor takes his or her cash and they go off and they buy another house. The reason for that is that you don't want people being responsible for a property for years after they've left. Right? They've taken the cash. Otherwise, cash would stay in bank accounts because everybody would be worried about a possible litigation coming back where they'd have to pay back the purchaser for a problem that they didn't find out. Now, the reason that works well for houses is that a house is a physical thing. You can take a look at it. So you can, if they're not that complicated. It's not like a car where you need a computer to plug in. You can go into the house. You can take a look at the basement. You can take a look at the walls. You can cut a hole in the wall somewhere and take a look behind there. You can have inspectors come in. You can check the wiring and the plumbing and all those things. You can check your zoning requirements. You can make sure that the property meets all the requirements of the municipal laws and bylaws. And then once you do all those things, you've done your due diligence and you can be satisfied that the property you buy is adequate, and the vendor gets their money and they are no longer responsible for the business. Now compare that, or not the business, sorry, the house. Now compare that to a business. A business is not a physical thing. It may have a physical component to it, like real property or inventory, but a business is relationships, it's processes, it's marketing, it's reputation, it's
brand,
employees, and these are things that you can't easily inspect, right? You can't go under the hood, you can't check the foundation and have an independent person. You have to rely to a certain degree on what the vendor is telling you, the person selling the business is telling you about the business. So if they're telling you that their processes are in place and everything's working, they can kind of show you an example of that. But you don't really know what that looks like until it's been in place for 6 months, a year and a half, 2 years. So in the negotiation process between the buyer and the seller, the buyer wants as many guarantees as possible because the buyer can't look underneath the hood and can't inspect the foundation. So they want the vendor to make some promises, and we call those the representations and warranties. And those are very important because a representation and warranty that you give to the buyer is a commitment that you're making as the vendor that the things are the way you said they are. And if it turns out that they're not, you can be on the hook for that.
So give me an example. What would be a representation or a warranty in a typical store, for example?
Well, so a big one would be taxes, that the taxes have been paid appropriately that the taxes have been paid and everything is in order and there's no problems with Revenue Canada.
Right. So you've remitted all the payroll remittances, you've paid all your GST.
GST,
everything's done.
Everything's done and done appropriately. We all know that Revenue Canada does like doing audits, and if you sell the shares of a company, we'll talk about that in a minute, that Revenue Canada can come around and say, wait a minute, we disagree with the way you've done this in the past. And you say, well, that's not me, it was the other owner. Revenue Canada is going to say, well, I don't care. It's the corporation, and it's the corporation that filed, and you bought the shares, so you are now the owner of that corporation. We're reassessing you for these 3 years that you weren't the owner for, but it doesn't matter, you're going to have to pay for that. So a warranty and rep that we're going to want in that situation is for the vendor to be responsible for any of those types of occurrences. Another one is that the vendor is legally entitled to sell these things. So you have to have if you're a corporation, your corporation has to be in order. You have to make sure that there's nothing, that any decision that the corporation has made in the past that may inhibit its ability to make these decisions in the future. Now, these kind of sound theoretic and outside the purview of most people because we all deal with real things normally. And this idea that a corporation may not be valid and may not have the authority is not something we really think about, but it is a thing. It's a thing that you have to pay attention to. So these are matters that we want the vendor to be responsible for. If the vendor doesn't have any employment contracts in place, or makes representations about the employees that turned out to be false, and the new owner is all of a sudden saddled with a bunch of liability because of that, well, you want the vendor to be responsible for that for a period of time afterwards. So we have the warranties and reps that are a big part of the negotiation. And we have the survival period. How long after you sell the business should an owner be responsible for? So this is an area of negotiation that happens between the buyer and the seller, where we're actually carving out risk. So how much risk should the vendor be responsible for, and how much risk should the purchaser be responsible for, and how long should the vendor be responsible for that? Right. So when we're representing a vendor, we want to make sure we limit that as much as we can, or within reason. There are reasonable, like the taxation representation and warranty is a reasonable one to expect, and it's a reasonable one to give out. But we want to make sure that those are limited and carved out very clearly of where the line of delineation is between what the buyer's responsible for and the vendor's responsible for. So, and these are things that buyers and sellers don't normally think about. They think about purchase price, possession date, how long afterwards, if necessary, does the vendor have to stay on to teach processes? That's usually like a separate agreement. It's just like a contractor or employee agreement. So those are the things that they worry about. How am I going to take over operations of this business? Right. But they don't think about the legal repercussions of that. And so that's where your lawyer and your accountant comes in, because we can help figure those things out, and we can help limit your liability in terms of how long you're going to be on the hook for. Because every now and then it does happen where a business falls through. I've had a client who lost the business entirely over a occupancy permit issue. And so these are not things that people normally think about. And this person, and now it was too late, he could no longer go after the vendor. So there was we pursued another avenue, and he ended up getting some compensation for that. But he lost a ton of money.
Municipal bylaws are just as important in many cases as your federal and provincial taxes. Yeah.
That's all part of your obligations or your due diligence if you're a buyer, and if you're a vendor, these are the things that you should make sure that you have in place. Right. And one of the representations and warranties that a vendor will normally make is that they comply with all municipal bylaws and provincial regulations and federal regulations. So if you have a business that doesn't comply with those things, and you're not aware of that, because there are so many regulations out there that even when you're trying to do everything right, sometimes there are things you just don't know about. And you'll be on the hook for those things that you don't know about, because you're making representations and warranties about them.
Right. Yeah, to the best of your ability, I suppose. So let's talk about another big thing that always comes up when you're selling the business, and that is, what exactly are you selling? All right? Are you selling
Right.
the actual corporation, the shares of the corporation, if it's a corporation, or are you selling just the assets? You know, just the contracts, just the relationships, and the brand, and whatever else might come with that. So this is a really important thing to figure out, and you need a lawyer and you need an accountant to figure it out. But why don't you talk to me a little bit about the pros and cons of both?
Right. So when we talk about this when we talk about buying a business, there's two ways of acquiring or selling a business. One is you sell the assets of the business. So if you're not incorporated, for example, if you're operating as a sole proprietor, you're selling the assets. Now, when we talk about assets, we use assets in the largest definition possible of the term.
Right.
Assets includes all hard assets like your desks and your computers, the vehicles, real estate, real property if you have it. But it's also selling all of the intangibles like contracts. So if you have a lease, then you're selling the lease. You know, your rights under the lease, you're assigning that to somebody else. You're buying all the intellectual property, you're buying client lists, you're buying reputation, or you're selling reputation. So these are all considered assets.
Right.
So really, from a practical point of view, whether you sell the assets or you sell the shares of the corporation, you're selling the business. It's just two ways of doing it, that have different consequences and repercussions. So if you're selling the business, your best bet is to sell the shares of the business.
That's the cleanest deal, isn't it, for the seller?
Well, it's the cleanest for the seller, because when they sell the shares, the corporation is still the same entity. You're just changing the puppet master, the person behind the scenes, that the shareholder. So you're taking your shares and you're giving them to somebody else, which means that all the liability attached to that business stays with that business, and now the new share owner, the new buyer, takes that with all of the history of the potential problems that exist. So if there's uncovered problems, the new buyer will be responsible for those problems when they come to light. So, for example, if you have a store, somebody comes along within just a few months prior to selling the business, they slip and they fall and they injure themselves. Right. Under the Occupiers Liability Act, you have an obligation to make sure people are safe, so they can sue you under that act for negligence because you didn't, clean up the banana peel or the ice that had formed in a reasonable fashion. Now, typically you have insurance companies that will handle those types of things, so you don't really need to get involved with that. But if for whatever reason your insurance doesn't cover you, or the award is in excess of the coverage that you have, you're going to have to come up with the balance of that. So that's the new buyer that's going to be responsible for that. If the new buyer doesn't know that this happened, or even the old vendor doesn't know it happened, this is an invisible liability. It's a liability that exists, but nobody except the party who is injured, who has not made that known yet, is aware of it.
Right.
So you have this. These are the potential. So the new buyer, when they take the shares, takes all of that unknown knowledge with them. Now, some of that will be covered by the warranties and reps given by the vendor, like in terms of responsibility for some of that. But really, our job, if we're doing a good job on the vendor side, is we're carving that out as much as we can to limit it as much as possible.
So to use that example, if the store only sells the assets, so the owner maintains his or her corporation, and sells just the assets, so the lease and the brand and all the contents of the store and everything else, and that same scenario comes up, it's the former owner that is liable, correct?
Correct.
Right.
So that's that. So from a vendor's point of view, it's better to give that liability to the buyer and have the buyer handle it. From the buyer's point of view, it's better to just buy the assets. You know, you'll often pay a bit of a premium when you're buying the assets, but it's better off buying the assets at that premium because you're not acquiring that history, that hidden history that exists with the vendor. So it's always cleaner from a buyer's perspective or from a vendor's perspective to sell the shares.
What about your employees? So let's say you're selling the assets, right? So your employees are employees of your ABC Corporation, but
Yeah.
but the owner of ABC Corporation is selling the assets, not the corporation. So the employees are going to move over, and presumably then they'll be offered employment at the new company, at the buying company. Is that the right way to look at it? And how does that change the employment relationship?
Well, so I'm glad you brought up employees. This is one of those examples where this is one of those situations where that example doesn't apply. So in the context of employment, a new buyer, whether you're buying the shares or the asset, you acquire the employees as they are. So if they have a lot of history with the company, you're acquiring that history with them. So any liability that exists there, yeah.
So you're not starting from square one if you have a 20-year service employee and you're not crazy about having that severance liability. You're still, if you're purchasing it, you're still getting that.
Yeah, there is. I don't practice employment law as such, but it's my understanding. I don't know if both employers would be liable in that case if that went to court. That would be something I'd have to look into. But the usual standard answer we give our clients is, look, if you're buying the company, whether you're buying the shares or the assets, plan on acquiring the liability. And this is usually an area of negotiation, again, between limiting the liability, carving out what the vendor's liability will be in these cases. I've seen deals fall apart on the issue of employment.
Well, it makes sense. It's a big issue, right? And it's often
a huge issue.
It's the biggest expense for most companies,
Yeah.
and it presents some hidden liabilities as well, doesn't it?
Yeah, or even not so hidden liabilities. Sometimes the liabilities are staring you in the. If you have a bunch of long-term employees and none of them have contracts, that's pretty easy to identify the liability there.
Yeah. So let's go into a few of these other items that are needed. So there are a few documents that have to be included in an agreement. So there's, a letter of intent. What is a letter of intent?
Yeah, so letters of intent are usually documents that lawyers don't particularly care about. Because a letter of intent is not an agreement. The letter of intent is simply that, a letter of intent. It just says this, I intend to do this, but it's not binding on any party.
Okay.
So letters of intent are usually used by brokers or buyers and sellers who are trying to narrow down some of the issues and give the lawyers and the accountants something a little more detailed to start working on.
Okay. And you'd be working on a business purchase agreement, right?
Right. So we'd get the letter of intent, and based on the letter of intent, we'd put together an agreement that would cover kind of the points in the letter of intent. So lawyers, my spouse is an accomplished corporate commercial lawyer, and we often talk annoyingly about letters of intent, and a lot of people spend a lot of time fussing over these. I think they're good, but you shouldn't spend so much time on them that it takes away from the time frame that you're trying to nail down these things, because it's not until you get it into the lawyer's hands that the contract that binds the parties gets negotiated, and that's the one you want in place as soon as possible. The letter of intent can often serve as a distraction in those types of things. So I think they have their place, but I don't think people should spend a ton of time worrying about them, because really at the end of the day, it's an agreement to agree, and in contract law, those don't exist. So you need an actual contract, and it means that during the contract negotiation, you may change some of the terms of the letter of intent, because the letter of intent is just that. It's just kind of a guideline that says nothing.
Makes sense. Well, what are some of the other legal documents, the more important ones from your perspective, that a business owner should be aware of?
So the important ones are, and they're kind of ancillary agreements to the contract, is the non-competition and non-solicitation independent contract. So as part of the share purchase agreement, the contract to buy and sell a business, we will say that we will create other contracts that will come into play at the time that possession happens, one of which is that the vendor agrees not to enter into competition within a certain period, certain area around the business, and that the vendor won't solicit any of the employees or customers or from the business to take them away from the business. Buyers don't want vendors to steal back their clients,
Right,
or customers. So that's an important one, and that's usually agreed upon in a schedule in the agreement. So the agreement says, we're agreeing to all of these things: possession date, price. These are all the warranties and reps that the vendor is willing to make. This is how the buyer will get compensated if some of those warranties and reps are broken, for how much time. And then on top of that, you agree to be bound by this other agreement that we attach as a schedule to the main agreement, that says that you won't compete against and you won't solicit. Now, normally vendors don't really care about that, because like we talked about earlier, if they're cashing out at the end of a 20, 30-year, 15-year business, the last thing they really want to do is throw themselves back into business again in the same area.
but it's a fairly common occurrence, isn't it? I mean, just in Winnipeg, there's a number of large financial services companies that sell, and then within 2 or 3 years, almost on the calendar date, they're suddenly back up and running, aren't they?
Yeah, I mean, it does happen, and people do have the entrepreneurial spirit, and some people, that's part of how they make their living, is they buy and sell businesses. So
they just get tired of Costa Rica and drinking mojitos.
yeah, I guess so. So many margaritas. So
Yeah.
I look forward to testing that theory out. I suspect I can get through at least several months on the beach before I have this urge to go back and get up early and have clients complain to me, and staff being unhappy about something or other, and all the various other problems that normally occur in the cycle of a business.
So let's.
So you have.
Sorry, go ahead.
So you have that the non-comp and non-solicit agreement, and then you'll often have an agreement where the vendor stays on for a period of time. Now that can be, I've seen that range from a couple of weeks or not involved at all to several years. So it really depends on the type of relationship you want to create there. What's the role of the vendor in that case? Are you there just for guidance for a short period, in which case we can carve that out pretty easily, or you're going to become an employee of the business and you're going to stay on in the business for an extended period of time. In my experience, those don't normally work that well. It's hard for somebody who owns a business to work in the same business for somebody else afterwards. So an exit strategy there makes a lot of sense. It's good. It makes sense to stay on for a period of time, but having an exit strategy there is important as well.
Right, or the old owner may move into the new company and run a particular aspect of it, or something like that.
Right. Yeah. There are a number. I've got a friend of mine who was bought out and stayed on with the company, became VP, and continues to be in that position, and is quite happy doing that. So
let's.
So it does happen.
I'd like to just deal a little bit with some tax implications. So another question that we have here is, there can be serious tax implications when you sell a business. As I said earlier, it's often the largest transaction of your life. So let's go through a little bit about that. And I think we're going to talk about capital gains, and this is really where I think entrepreneurs can save a lot of money and really prepare for retirement if they've managed their business well.
Yeah. So the golden goose under the Canadian Income Tax Act is the lifetime capital gains exemption.
Okay.
Every Canadian has access to a fund, if you want to call it that, a limit, where they can sell property that qualifies, and now this is language used in the Income Tax Act, but property that qualifies, capital property that qualifies, you can sell that property and you can claim part or all of your exemption, which means...
So let's just back up just for explaining what capital gains is. A capital gain is you start a company and it's worth 0, for example, and 20 years down the road, you're now contemplating selling it for $1 million. So the capital gain in that case is $1 million.
Technically, it's probably more like $999,999 because you have to start with some value in the corporation, and it's usually $1. So, so yes, so it could be $1 or $1 per share. It could be $100, that type of thing. So you're right. The capital gains is the gain in value. Now, it's not limited to businesses. If you have a cottage, for example, or even a house, you have capital gains in there. If it's your principal residence, there's an exception under the Income Tax Act, which means you don't have to pay capital gains on the sale of your house. But there is a capital gain there. It's not taxable.
Right.
So the capital gain is the accumulation of value. So the difference between the purchase price, or the sale price rather, and the purchase price. So in the kind of real estate markets that we've seen in the last 10, 15, 20 years, we know there's been a dramatic increase in value. So most properties sell and there's a gain there to be done. If it's not your principal residence, a cottage or a revenue property, you'll have to pay capital gains on that.
Right.
Now, capital gains is you take half the value of the gain and you add that to your income, and then you're taxed on that. Okay, so if your gain is $100,000, you have a cottage, you pay $50,000, and you sell the cottage for $100,000 or $150,000. Your gain is $100,000. You take $50,000 of that and you add that to your income, and then you're going to be you'll be taxed on that. So capital gains is the best tax burden under the Income Tax Act. It's the only one where they take the revenue, the gain that you get, and they cut it in half, and they say this is all you have to report. The other half is going to be tax-free. You don't have to pay tax on that. So already out of the gate, a capital gain is good for the taxpayer. Then you add to that this golden goose under the Income Tax Act that says that you have this exemption. And currently the exemption is $870,000. I can't really remember off the top of my head. It changes every year. Close to $870,000. If it's farm property, it's $1 million. And you have that. So any gain that you have, as long as it qualifies under the Income Tax Act, and that's important, you can receive that money without paying any tax at all.
None.
So no tax.
So
Zero.
let's say the sale price for your company is $800,000, and that's approximately equal to your capital gain. You would have a zero tax bill on that sale.
You would receive $870,000 in cash, which you would put directly into your personal bank account, and you can start buying your margaritas
in Costa Rica.
In Costa Rica without any fear that you owe money to Revenue Canada, as long as it's done properly. So I used the example a couple of minutes ago of cottages. Cottages do not qualify for the lifetime capital gains exemption. So don't go out, sell your cottage and try to claim your lifetime capital gains exemption. You won't be able to. But the shares of a corporation of your own business, you can sell as long as they qualify. So you need to make sure that you talk to your accountant about that. There might be some work you need to do a number of years prior to selling. If you have too much cash in the corporation, they may not qualify. The shares may not qualify. So you have to make sure that you're on side, and you need to speak to your accountant about that. There are very specific rules under the Income Tax Act about what qualifies and what doesn't qualify. But if you do qualify, which shares of a Canadian-controlled private corporation do qualify, provided all these other requirements are met, then you can take advantage of the lifetime capital gains exemption. So we go back to this, the difference between selling a business, selling the shares of the business, or selling the assets. If you sell the shares, you'll usually receive less money up front, not by a big margin than if you sold the assets, but usually there's a premium for selling the assets. But you will then have this huge advantage of not having to pay taxes on the sale of your business. So that really is, under Canadian income tax law, for most, I'm not going to say for most Canadians, because it's not most Canadians that own a business, but
right.
it's the closest to the little guy that you're going to get in terms of giving a really, really good tax break.
So now, so if you sell your assets, then the sale price is going to go into your corporation, which is still going to exist, and then
Correct. So if you own, so if you don't own a corporation, if you're a sole proprietor and you sell the assets to your business, then all of that money comes into your income.
right.
And you'll have to talk to your accountant about that, because I'm not really entirely sure how the taxation would work on that.
Okay.
But if you own the shares of a corporation and you sell the assets, it's not you, the individual, selling the assets, it's your corporation selling the assets. So in your case, it's Dooley Communications. That's not Adam Dooley. Adam Dooley is a share owner of Dooley Communications, but Dooley Communications is the legal entity selling the assets. The income or the sale price will all go into that corporation. And when you want to take out money from the corporation, you need to take it out as dividends, and you'll pay a dividend tax on that, which is supposed to be equal to income tax level of taxation by the time it comes. It's not quite, but it's pretty close to it. So you would find yourself in that situation where you would treat that corporation as a bank account, essentially, and you would withdraw money from that on a regular basis, on an annual basis, to find that balance between your tax rate and the money you need to live. And then you would just use that money out until there's nothing left in the corporation. You'd wind up the corp at that point. Right.
Makes sense. Well, there are so many different ways to look at the sale of a business, and each one is going to be different. And I think you're absolutely correct. You really need a great team, a good accountant, a good lawyer. I highly recommend folks who are watching this that if you're in this situation or know someone who is, give Philippe and his team a call. They can give you great advice and very easy to access and understand advice that will protect you over the long run. So I think we're going to wrap up here today, Philippe. Thanks again for sharing your great knowledge of this topic. To our viewers, please like and share this live stream. Send it to somebody, a business owner, friend of yours, who's maybe one of those 3 times a year when they're thinking of selling and dreaming of Costa Rica. Please like the TLR Law Facebook page or Instagram account if you haven't already. I also just want to close by reminding people that TLR has 3 locations in Winnipeg now. There's the one at the foot of the Provencher Bridge in St. Boniface, over on Pembina Highway at Markham Road, and also at Sargent Avenue and Wall Street. And finally, you can find all this information, including a copy of this live stream, at TLR Law's website, tlrlaw.ca, where you can subscribe to Philippe's always insightful and witty newsletter. Thanks again, Philippe, and we'll talk to you next time.
All I can think about right now is Costa Rica.
You and me
Thanks,
both.
Adam.
Winter's starting. Are you kidding me?
I know.